an absolutely scintillating webinar. My name is Ashwin Bishnoy, and I'm a partner with Khattan and Company. And we are here to talk about Indian real estate investing. It's one of India's bulwarks in our economy, and you'll hear more from this panel. And on behalf of INSOL India and the events committee, I'm thrilled to invite this panel to discuss investing in Indian real estate credit, the opportunities and challenges. Our panelists are Vikas Upadhyay, who is Managing Director with Cerberus Capital Management, with several years of experience of investing in credit situations in India and outside India. So welcome, Vikas. We have Birinder Sahani, who is Principal Investment Officer at Swami Fund, again with 2 decades of experience. And Swami Fund, as we all know, has provided much needed last mile financing for several of our projects to keep them going. We also have with us Anuj Jain, who is a senior partner with KPMG. Again, several years of experience under his belt, and a leading real estate insolvencies under his belt as well, not to mention JP. We also have with us Akash Jari, who's co-lead and senior resident fellow at Vidhi Center for Legal Policy. And Akash has been closely involved with some of the changes that we're going to discuss. And of course, we have my good friend and moderator, Ashit Shah, who's senior partner at JSA and also chairs their finance practice. So again, on behalf of INSOL India and the events committee, thank you so much for sparing time to our panelists and joining this session. We are quite excited to hear what you have to say. And with that, over to you, Ashit.
Thanks so much, Ashwin, and good evening, everyone. Thank you for joining today's webinar organized by INSOL India on investing in real estate credit. As we know, private credit is rapidly becoming an alternative source of financing in India. Some reports estimate that last year alone, there was about $8 billion of private credit deployed. And of this, almost 1.7 to 1.8 billion was in the real estate sector. So real estate is booming in India. The sector is today the second highest employment generator after agriculture. Some reports estimate that the sector is valued at $500 billion and is likely to grow to $1 trillion by 2030. So almost 13% of the country's GDP. And there have been several legal and regulatory developments that have helped and sustained the growth in the sector. Starting from 100% FDI that has been permitted in the construction and development sector. Then we have RERA that has brought about better discipline amongst the developers, provided additional rights and more transparency to home buyers and unit holders. You have the promotion of real estate investment trusts that has provided an avenue for exit to investors in commercial real estate and also opportunities for the public to participate in such projects. There is the government's Housing for All initiative, which was launched before the pandemic, and it continues to be a driver for growth in the affordable housing segment in the country. And last but not the least, we've had the Insolvency and Bankruptcy Code that has provided another avenue for resolving distress in this sector. And just to give some statistics, out of the almost 900 resolution plans, which were approved until December 2023, 17% of those were in the real estate and hotel sector, which means you had more than 150 insolvencies in this sector that have been resolved in the span of just 7 years. So after manufacturing, the real estate sector is actually the second largest sector that has benefited from IBC. And several promoters have lost control of their companies, and creditors have been truly in the driving seat for the first time in India. The recovery rates have increased significantly from what they were before IBC, and the recovery timelines have reduced dramatically. We've also seen several alternative investment funds that have registered in India with SEBI and in GIFT City over the past few years. and many of them are focusing on the real estate sector. Foreign investors, including institutional investors, sovereign wealth funds, pension funds, stressed asset funds, family offices have actively invested in real estate focused AIFs. So private credit in this sector is gaining a lot of momentum, mainly due to flexibility in the way private credit players are in terms of deal structuring, the minimal end use restrictions that are there, and the speed and agility with which the private credit players are able to deploy their capital. With this backdrop, I wanted to start our panel discussion today. And my first question is to Berinder. Berinder, the Swami Fund has been very active in investment across several real estate projects since 2019. And you've seen many deals in this sector involving private credit. What role do you believe that private credit is playing in this sector? And what are your views on some of the factors that are accelerating the growth of private credit in the real estate sector?
Sure. Asid, I actually lost network for like 10 seconds. If you could just repeat the question.
Sure. So my question was, given the active involvement that you have in this space, and you must have seen lots of deals involving private credit in real estate, what is the role you believe private credit is playing in this sector? And what, in your view, are some of the factors that are accelerating the growth of private credit in the real estate sector?
Got it. Okay, thanks for the question, Asid. All right, so let's look at what private credit has done, and let's look at it a little bit segment wise, right? So broad three segments where we have seen in real estate flow of capital. 45% typically goes to residential. We've seen 35% going into offices. The rest 15% going into warehousing, hotels, student housing, data centers, etc. Right? And private credit has actually played a role in each of these segments. So the largest role, of course, has been in the residential segment. And so the earlier sources of financing for the residential segment were banks, HNIs, NBFCs. And each of these, because of various regulators, market conditions, have unable to invest. So let's look at each of them. Banks, the risk weightage on banks started increasing somewhere in on real estate, started increasing in 2016-17. So the allocation of banks to real estate segment really fell from there, followed by the NBFC crisis in 2019, where 7-8 of them actually shut shop. So probably created a hole of around $4 to $5 billion of funding in the market. The Companies Act changes when 2013 was actually, Companies Act 2013 was actually rolled out in around 2016-17. The HNIs who were big financiers of real estate developers, they couldn't actually fund these projects, right? So although private credit has been available right since 2005-6, the role of private credit is, from the regulator perspective, from both RBI's perspective and from SEBI's perspective, has now become even more bigger since 2019, right? Because that's where they believe the risk capital into the sector should actually be coming inside. It's been interesting. Private credit can actually play so many different segments of real estate, right? So private credit can enter into the land stage and approvals, which typically banks and NBFCs, of course, since 2021 are not even permitted to finance this. So entering at the land stage, doing a bunch of refinancing transactions in the market. One could look at buying out portfolios. One could look at buying stressed assets. Bunch of different strategies in the residential private credit space. Similarly, one could look at other spaces like offices and warehousing, more from a asset ownership perspective. So all this are various opportunities in this segment. Right now, post 2019, relatively the the flows to India have been a little lower. Also driven by the fact about what has been happening globally. But just given what's been happening with China, what's happening to China in the last 2 years, our conversation with a lot of international investors have been that they want to look at India more seriously, more from a long-term focus perspective. And hence, I'm sure the next coming years are good for private credit in real estate in India. Over to you, Asit.
Great, thank you. I think that's a very useful insight, Barinder, and I'm sure given what's happening in some of the other jurisdictions, there is definitely going to be more interest in India. There will be more, capital available at the foreign levels for investment in India. I think my next question is for Vikas. Vikas, as part of a global private credit fund, you've seen your fair share of deals across a variety of asset classes within the real estate industry. So from a private credit investor's perspective, do you think that there are any specific asset classes that are more attractive than others in the real estate space? And also, what are some of the key issues that you would assess when you are considering a private credit deal in the real estate sector?
Sure. Well, thanks, Ashit and Virender for that background, and thanks, Ashwin, for the introduction. Good afternoon to all participants and my fellow panelists. So on the question, really, rather than framing the discussion in terms of relative attractiveness, I think probably more instructive to look at some of the key characteristics of these different subsegments in the larger real estate asset class and how these affect the demand and supply for private credit, right? And I suppose it'll be helpful to offer some facts to support the context here. We've spoken about this. There has been around $8 billion of capital deployed in the asset class last year into private credit. Now, if you peel back the layers on this, right, roughly 60% of this deployment of $8 billion comes from three large non-real estate corporate groups, right? So that leaves around $3 billion of balanced transaction volume. And of that, around 50 to 60%, so around 1.5 to 1.8 billion dollars is just in real estate, right? So probably the most active sector when it comes to deployment value, and certainly I think the most active sector when it comes to deal volume, right? The number of deals that have happened. And mind you, this is just new money deployment. It doesn't talk about any existing real estate loan portfolios which may have traded hands from the NBFCs into the hands of private credit players, as Virender was mentioning, right? So if anything, this number is probably a bit underbought, right? Now, if you were to double click on this number, of the 1.5 to 1.8, roughly about, I would say 60% is deployed into residential real estate. And all of these other subclasses, commercial, hospitality, malls, warehouses, data centers, I think would make up the remaining 40 to 45%. And I think last year, if I'm not mistaken, commercial office and hospitality make up most of the balance. But see, the balance of supply will keep changing based on where that particular asset class is in its maturity cycle and the specific macro trends which are affecting that class as at that moment, right? And Virender kind of alluded to this, like what is happening in the Western world with, say, office, the commercial asset class. But what these numbers do tell you, right, is that residential has been a very strong source of demand for private credit, at least in India, and has taken up more than all of the other subclasses combined, right? And few reasons for this, in my opinion. The first is that unlike residential, all these other asset classes have some, I would say, operational or service element to it, right? So it will vary in terms of complexity, but all of the scale asset owners and investors are also operating and investing into a business apart from the underlying real estate, right? So there is a going concern wrapped up with the underlying real estate asset. It could be office services, it could be logistics services, hospitality, data services, whatever. But what this dynamic does is it self-selects for more scaled, sophisticated players who have better access to capital, whether it be bank capital or equity capital. And these guys won't necessarily need to tap into alternate credit sources, such as private credit, right? So that's one demand side consideration. The other, which is a more supply side consideration, is that depending on the level of maturity of that subclass, it may probably be more suitable for, from a risk standpoint, to be, equity funded. So sectors which are still, in a formative stage in India, such as say warehousing or data centers, you will find private credit supply to be slightly limited. Of course, once such assets are fully built and operational, they will readily attract bank funding. You will probably be able to raise LRD facilities on these assets if they're operating. So that goes back to the first supply point that I mentioned. Now, if you look at residential, right, it's the oldest and most mature asset class in the world, and certainly in India. In India, the sector has very strong macro tailwinds. Demand for housing is the highest it has been in the last 10 to 12 years. But at the same time, this asset class has much less barriers to entry and is hence it's quite fragmented. Developers are smaller, they're not able to attract quality equity financing for early stage projects. And as far as the banking and the NBFC capital goes, as Virender mentioned, there is now a regulatory bar on financing at the pre-approval or land stage kind of project. So this dynamic actually has ended up creating a lot of deal flow for the private credit market. And the other attractive aspect I would say in residential credit financing is that it's self-liquidating in nature, right? And even that self-liquidating dynamic is actually very granular in nature. Some of the other key, regular cash flows will keep coming in as the sales cycle progresses. So exit liquidity in that sense is built in to the financing model. Unlike other asset classes where you'll have to sell like a large chunky asset, right? Or depend on somebody else coming in to refinancing. In residential, it's not like that. You will get kind of an exit through liquidation of the product itself. But there's a flip side to that dynamic, and which it kind of brings with it some unique challenges, which I think we'll discuss as this discussion progresses.
Thanks, Vikas. We've heard, of course, from both you and Virender on how there is so much of opportunity, so much of money. Residential, of course, is taking up a large part of the supply of the capital compared to other sectors. I wanted to actually ask Anuj a question now. Anuj, as an advisor to various borrowers that have raised private credit in the real estate space, what is your view on some of the concerns that a borrower may have? And concerns may differ if it's a residential project, it may differ if it's a commercial or a hotel project that they may have when they're raising private credit from private credit funds, and how do you deal with some of those issues?
Thanks, Ashit, for the question. First of all, let me thank INSOL for having me over. A great set of panel and glad to be with fellow panelists. Ashit, I think see as an advisor to borrowers, I would say that private credit, the single biggest challenge which most of the clients face today are that it is expensive. If you add all the costs of withholding taxes and cost of hedging, if it's foreign capital, then it tends to get to the high teens, probably around 18-20 is I would assume normal for private credit real estate transaction. And this is one of the reasons it is high is because there is no other or very little alternate financing available to the real estate sector. Either it's equity or private credit, because banks typically don't tend to lend. Banks are forbidden from lending against land. There is very few players like Swami who are available in the specific real estate sector. And what we lack are financial institutions like REC, PFC, HUDCO, who actually provide credit, who are supposed to provide credit to the sector. So as a result, the cost tends to be very prohibitive. Second, I think the ecosystem is still limited. Deals are happening, but there are still very few players who focus on real estate. Not everybody understands real estate that well. So that is a challenge. There is lack of domestic private. I think there is lack of domestic money in the private credit space. Most of it, at least whatever I understand, most of it is still foreign capital, and it comes with its own set of challenges. And sometimes there are regulatory legal challenges in terms of creating security over land, or it needs to be FDI approved project. Some of the smaller projects or old projects may not be eligible for financing. So that is one challenge. The risk appetite of investors is limited. They would typically tend to come in a clean project, whereas the biggest problem is funding projects which are either stuck, or they are delayed, or there have been cost overruns, or they are in a difficult situation. And one other challenge is that, if there's already an existing lender in the project, sometimes the entire negotiations on sharing security rights, lender rights, who gets priority, who doesn't, all of that become quite challenging to resolve. So that is a big one. Secondly, see, what happened is, from an unregulated sector, real estate has become completely regulated. RERA was introduced in 2017. RERA is, and there are a lot of strict provisions on what you can and can't do. Unfortunately, the RERA Act doesn't really recognize private financing that well. So the interplay between borrowed money and RERA, how you can use the escrow, whether the credit payment has priority over escrow, can you do a refinance? All of this is assumed. I don't think it's very clearly defined in how you can address it through the RERA. And lastly, I would say one big challenge which borrowers always face is that, given the judicial activism, the jurisprudence around home buyers, around real estate, whether who gets priority, whether it's secured creditor or home buyers or the government authority, because all three sets tend to claim in an insolvency situation that they have priority over the other two. And I think we need to, somewhere at the policy level, address this issue and bring it to rest. Because until that issue of who has priority over cash flows in a liquidation or an insolvency situation, the lenders would tend to typically build all the risks in the pricing, and that will add to the cost and the scarce availability of credit. Yeah.
Fair points, I think, Anuj. You raised some valid points around, classification of creditors, which makes obviously this an expensive source of capital as well. Vikas, from your perspective, what do you see as some of the unique challenges that private credit investors would face in the real estate asset class versus other private credit asset classes, and how do you suggest those sort of challenges and issues can be dealt with so that these opportunities can be tapped better? I know Anu just touched upon some of the concerns that borrowers face, but maybe it would be useful to understand from an investor's perspective, what are the concerns that you face and how you have seen these being addressed, or any thoughts you have on how those can be addressed.
Right. So I'll focus my thoughts more on residential real estate, because that's that obviously is a more germane kind of consideration. Now, and before getting on to the challenges, obviously first the opportunity, like, which I think is immense, right? We have such strong structural demand drivers for housing in India. We have a young population, we have a growing middle class, we have very low housing ownership, we have very low mortgage penetration. So all of the ingredients for like a multi-decade growth cycle, right? And at the same time, traditional credit financing channels for developers are severely constrained, as all the panelists are saying, whether it be banks or NBFCs. Now, it might be a regulatory bar, or it might be just like a risk consideration. And if you think about this, this combination is actually pretty rare, and it tells you that you will continue to see residential real estate being a very robust source of private credit deal flow, at least in the near term. Now, of course, every opportunity will have its own challenges, and I think there are three key challenges when you go about underwriting deals in this sector, and that's vis-a-vis any other kind of private credit asset class, whether it be other real estate asset classes, or just the corporate kind of credit asset class. And that the first just goes to, an earlier point I made about the key difference in the nature of residential versus other real estate asset classes, or, other corporate asset classes. In that you're not really creating any kind of a perpetual asset here. There is no source of enduring value. Instead, there is only, like, a finite set of cash flows. And hence, if there is any delay in those cash flows, the erosion in value for the developer or the owner is very large, because as Anuj rightly mentioned, private credit is a relatively expensive source of capital. It's obviously not as cheap as bank credit, and it's not as expensive as equity. It's somewhere in between. And to have a situation where the private credit financier ends up taking a very inordinate share of the finite cash flows, that's just a very bad incentive structure to get into, right? So where the developer has really no skin in the game to complete the project. So one has to think about completion timing and risk of delays very thoughtfully when kind of entering into these deals. The second consideration and second risk, which I think is unique to India and some other parts of Asia, really, in that almost always the construction financier will not be the only lender or source of capital for the project, right? The nature of most of these projects is that home buyers, pay based on construction milestones, and that is oftentimes the largest financing source for the project. Now, whether home buyers are financial creditors, they're secured, unsecured, or they're operating creditors, I mean, in my mind, the order of priority is a policy level detail, as Anuj kind of mentioned. But one can't ignore the fact that there is this separate class of creditor in this project with sitting alongside you, and these are basically individual hard-earned savings, right? So there are more than purely economic considerations at play here, and that is a risk which one has to think through very carefully. And oftentimes you have to just price that risk in, because it's kind of inevitable, at least in the residential real estate sector. The third is, I would say, slightly obscure. It's a blind spot which I've seen, the earlier cycle of real estate lending kind of suffer from, primarily, the NBFCs, is that, there is an excessive focus on project, right? On the project, and you're not focusing, or sometimes you're not even aware of the larger corporate balance sheet, right? And this is, of course, something, the insolvency regime is also kind of grappling with. But oftentimes, as real estate lenders, we kind of tend to forget that the project is housed in a corporate balance sheet, right? There may be some other liabilities sitting in there. There may be statutory liabilities. There may be liabilities of some other project which is in trouble. And the risk of contagion, for your investment is actually very real, and it needs to be appropriately diligenced and understood. Right. I think these in my mind, very, going back to first principles, I think these are the three things which are very unique to residential, and, like, one needs to think through these very carefully. And unfortunately, I think some of these things just, you will have to kind of internalize those risks and just, like, price them into your deal. Not all of that can be mitigated from the word go, but definitely one needs to be very, I would say, thoughtful about all of this. Once you're kind of looking at a project level financing, and all of these risks, like, kind of get magnified manyfold, right? When there is, like, an insolvent project, or there is a stressed project, or there is a project where you're coming in where there is already a set of home buyers. There is like a stuck project. There is already an existing lender, and hence there are multiple stakeholders who you are trying to kind of balance together. So I think those, in my mind, are, like, in that sense, top of the list for things one needs to kind of think through while underwriting deals in the sector.
Great. Virender, do you have any sort of thoughts as well around this? And
Yeah, no, I kind of agree with both the speakers. But here's what I think interestingly, what the regulator has done, especially from a fiscal and monetary perspective, right? The last 6 months to a year's time, we are seeing this increasing stability in the dollar rupee conversion, which really one of the ways to ensure that private capital actually gets attracted to any kind of situation, whether it's equity or private credit. And to Anuj's point that yes, it's the right now the cost of private credit is so expensive. That's also to do with so much of uncertainty around regulation, which was earlier there in India, right? But increasingly, if we are looking at more stabilized regimes across, both the fiscal and monetary levels, I think there is some scope of this cost actually coming down, because people would need to say, hey, look, yes, I was factoring in a large amount of hedging costs, and but now with more stability around the rupee, maybe this cost uh, could actually be much lower than what I thought. From a resolution perspective, from opportunities in IBC perspective, uh, I kind of agree with Vikas that it's it is a longish kind of journey that one needs to be looking at, especially once you and both Anuj and Vikas both pointed out, saying that look, with Indian courts and with maybe the number of judgments which are coming across this segment are still few, and maybe a couple of years down the line we'll have a lot more judgments coming which establish the priority of funding or the priority of payouts which happen to various stakeholders. Till then, so we participated in like more than 25 of these situations, and most of these situations have been like where each of the stakeholders felt that whatever resolution plan has actually come in has not been very fair to them. And then there are appeals and reappeals which are sort of constantly happening, and we are generally waiting on the side saying that okay, we've already issued a head of terms to these projects. Hopefully, if they come through with a solution, we get a chance to deploy the capital, right? We also actually tried to do a lot of interim funding in the resolution processes. The challenge with the interim fundings that we've been facing is um, just establishing a first charge on both uh, the underlying asset as well as the cash flows has been a little challenging, right? And just how the rollover would actually happen in uh, those have been a little uncertain in our cases, and hence how the interim funding would finally turn into a final funding has been a bit questionable. But some interesting cases that we have actually seen is if you follow the Supreme Court judgment of Haribhai Tota, where under Section 29A, it says who are like disqualified people who can't participate in these processes, but opening it up to the MSME segment, saying that if you are MSME, then the promoter can actually participate in resolution plans. We've seen that has been pretty interesting, and we've seen a lot of the promoters come back and say, hey, look, who knows this project better than I do, right? I exactly know what's going on, and hence finding in resolution for those kind of projects have been a little bit easier. So that's just generally been our experience of dealing with these investments.
Great. Yeah, no, I think you're right. I think in the real estate sector, if you do have the promoters' cooperation and the promoters' support, then implementing the resolution plan and getting the project up and running is much easier. And I think that goes to my next question, where I wanted to actually discuss how we different ways of resolving stress in the real estate sector. And my question is to Anuj. Having worked on some of the largest insolvencies in this sector, it would be very interesting to get your insights on some of the challenges that were faced during the resolution process for real estate companies, especially around, drafting and preparation of resolution plans. And how do you see that different from normal corporate insolvencies? What are the factors that, one should try and keep in mind when you're bidding for a real estate company undergoing insolvency?
No, fantastic question, Ashit. And so I'll tell you, real estate is definitely challenging. I am still not completed JP. It's the longest running case in IBC. Probably we've completed 7 years. We're in our 8th year now, so you can imagine. And the challenges are multiple. See, I think the first biggest challenge we need to, and Vikas somewhere alluded to that, we need to appreciate is that a lot of home buyer savings are invested. So this is classically residential real estate would be a B2C insolvency. There is a lot of home buyers involved, and home buyers, when life savings are invested, tend to take decisions emotively. So unlike any other commercial law, it is not a financial decision where there is priority of rights. People acknowledge, people understand that they need to take haircuts. Here, it's emotional decision by one set of creditors versus a rational or financial decision, and sometimes it becomes extremely challenging to balance the two. Secondly, home buyers and lenders, secured financial lenders, are mostly have different interests and very often have opposing interests. So in an insolvency situation, secured creditors would be interested in recovery, home buyers would be interested in completing their houses. Now, the bone of contention is the assets of the company. So who gets a first priority over the assets of the company, whether it is used to build houses or whether it is used to repay lenders? That's always a challenge in insolvencies. Then we have this evolving jurisprudence. So every few months or weeks we have a judgment where sometimes authorities made secured, sometimes we have rainbow paper, where government authorities, which are supposed to be fourth in the order of distribution, suddenly become on top of everybody. Home buyers are made financial creditors, whereas essentially it's a performance obligation on the business. It's a service contract. Now, insolvency says there is a moratorium. When insolvency starts, lenders cannot be repaid, but home buyers are also lenders. And when you finish houses, deliver houses to them, you're actually clearing a set of liabilities compared to the other set of liabilities. This is actually a genuine problem. And whether delivering houses to home buyers during insolvency, will it tantamount to preferential payment under 43? So these are some of the areas which are yet not discussed or yet not been resolved by courts, by jurisprudence. Then whether one other question comes that, if home buyer funds are used, or funds of the company which were in RERA account prior to insolvency are used to service interest or payments to the lenders, now does it tantamount to an avoidance transaction? Can that money be recovered from the lender? That's again something which is very difficult to address. Another major issue, which was actually one of my judgments only in Supreme Court, was the entire aspect about third-party security. It's a very common transaction in lending. Third-party security is provided, but in an insolvency situation, it takes a completely different color altogether. And I think I'd end there. Lastly, the only last point is that when you put up a resolution plan, any investor, any buyer puts up a resolution plan, he doesn't know when it's going to get completed. As you know, real estate is time sensitive. The more you delay implementation of a plan, the more expensive it gets and the more difficult it gets. But under insolvency, at least the certainty of time is not there, because sometimes courts can take as much as 1.5 years, 2 years to actually approve the resolution plan, and then implementation takes similar time after that. So those are some of the key challenges that I feel I have come across in various insolvencies, both as a resolution professional as well as an advisor to RAs who are putting up plans for insolvent businesses. So
Thanks for that insight, Anuj. And I think the home buyer concept is, quite unique to India as far as insolvencies is concerned. And, we are, as you said, grappling with various sort of issues. I think having said that, my personal view, and I've always been a fan of the IBC, because I don't want to go back to a stage where IBC was not there, right? Because IBC has made a huge change in the mindset of promoters and the mindset of creditors. For every new deal that we look at in the private credit space or in any lending space, lenders are stress testing situations of what would happen if a company goes into IBC, how would we get resolved, what would our payouts be. There has been a lot of sort of movement in this law since it started off. It's been amended several times. Judicial precedents have clarified many things. There are some wrinkles, as you said, that need to be ironed out. But I do agree that there are some concerns around home buyers, around the real estate space. And I think that sort of leads me to my next question, which is for Akash. Akash, thanks for being with us today. You're part of one of the foremost think tanks in the country, and it would be great to get your views on whether the IBC in its current avatar facilitates the resolution of insolvencies in the real estate sector. Are there any concerns or changes that you think that can be brought about in the current regime? I know there have been discussions in the past. There have been some consultation papers as well on what sort of changes that can be brought about to facilitate real estate insolvencies. So would love to hear your views on this. You've been very patient through this, panel discussion. So it would be great to hear your views.
Thank you so much, Ashit, for your question. Thank you so much for inviting me for this panel discussion. There are two things, like, for example, when you talk about the insolvency policy and also the real estate policy, to keep in mind is that, as Vikas was also pointing out and Anuj was also highlighting, that the entire unregulated sector from the real estate side, with the development of RERA Act, it started becoming a more of a regulated sector. So we still have two sets of, like, if we make a clear demarcation, one type of project would be a pre-RERA project and certain projects would be the post-RERA project. So that policy is still being implemented because it started with the development of IBC, like 2016 and 17. Now, the place where IBC actually becomes very important is that as we are generally seen, that there are 2-3 aspects like stakeholders when it comes to real estate companies and real estate insolvencies. One are the home buyers, there are lenders, there are the borrowers by themselves. So we don't have right now, like with the initiation, because RERA primarily focuses from the perspective of home buyers. They want to give some protection to them. Then it comes to the Consumer Act. So a lot of, like, as lawyers, I've also seen a lot of matters which end up going to the consumer forum, wherein also real estate becomes a very major issue. But what IBC actually does is that it might be happening because of the triggering point that was a default, that it was able to provide that one-stop platform to bring all the stakeholders together and raise these important questions that now what is to be done. Because from a regulatory point of view, there is no regulator, a centralized regulator, who can see different aspects. Who can see the concerns of the home buyer also, who can see the concern of a lender also, and also try to ensure that how the stress of the company has to be ensured. So the reason where IBC as a policy, of course, I'll also be discussing how it slightly disaligns with the objectives of home buyers. But as a platform, it was a great effort because it essentially provides that one platform where everyone can come on board and try to figure out this issue that is happening. Because otherwise, there is no centralized platform, and different states, different countries, and other laws also have tried to tackle it only from a one silo perspective, not taking the holistic perspective. So that is the where IBC makes a very crucial intervention. Now, when you talk about the fact that, so as you were also highlighting, that one of the major changes that IBC actually did was it brought in the concept of a creditor and control it. Once the company has defaulted, it brought back the creditor to come forward and actually play a major role. Now, when the COC was getting conceptualized, as Anuj is also highlighting, that it was conceptualized as financial creditors, who are essentially people who can take much more decisions with respect to the viability and feasibility of the company and what can be a more rationalized decision. So that was the entire idea. So a slight disalignment with respect to IBC, and when the entire home buyers are brought in as a financial creditor, happens with respect to the fact that the home buyers will always be interested more to get the flats and the asset. That's something that the buyers are offering against a value that can be derived for the company. They will always be more interested to preserve that. And that is a slight disalignment, as I'm seeing in the discussions also, generally comes up. Now, in terms of the innovations that are happening, because slowly and slowly, as we are saying, there's a concept of project-wise insolvency, which is also coming up, wherein the focus has been more of a project. But that also slightly disaligns with the IBC perspective, because IBC tries to tackle the insolvency of the company as a whole. As Vikas was also pointing it out, that when the investments actually happen, a lot of focus goes on focusing on the project, whether the projects are viable, rather than understanding the overall solvency situation of the company. And that's a disalignment we are also seeing in the IBC right now, because after the 2020 amendment, so right now, when you talk about the initiation of the process, these are the home buyers, a 10% home buyers, 100 people who can actually go to NCLT. And because NCLT is only dealing with a project, they will always respond to a project specific solution, because the concerns are very much different. Now, when you talk about project-wise insolvency and reverse insolvency, it's actually a very good initiative. But the problem with that initiative is that it doesn't capture the spirit of IBC, because in IBC, you are trying to resolve the stress of the company as a whole, as compared to project, and the entire focus of the project as insolvency ultimately goes to the fact that you have to give flats to the home buyers, and that becomes the primary focus, rather than ensuring that the lenders also gets an exit. Because IBC, apart from giving an opportunity to exit to the company and the promoters, it was also a very good exit opportunity for the lenders when they realize the fact that if they have any issues with their stress, it also gives them that opportunity. But the focus of project as insolvency slightly differentiate with the interest of the lenders, and that is a point where, because more and more when these cases will evolve, this will be a very major risk factor that the lenders will also take into account, because as more and more judgments are coming with respect to project specific committee of creditors, it will be a strategic call for lenders to ensure that if at all a project goes into insolvency tomorrow, they should have some level of say. So rather than, for example, creating a collateral on another project, they might be interested to more to create a collateral of the underlying asset which are there a part of the project, because they would want to be a part of that COC to have that controlling stake. So from a strategy point of view, these things become very much important for lenders, because ultimately, if they are not having a say in the COC, they might not actually have a say in the recovery through that project.
That's true.
Just add one part to what Akash was saying. So I've been a part of one resolution where, it's an unfortunate scenario. But one of the main things which has been really important in solving any of these things is having an authorized representative of the home buyer. Because we started off with a case where, there used to be like 100 home buyers a part of the calls. There was just no action or coming to a certain decision. But this minute the authorized representative actually came into play, we started seeing movement which was actually happening, and we are taking, at least going in the right direction, and he could align all the home buyers together. So I think that's one piece which is definitely recommended if you are being a part of a insolvency situation.
Yeah, just to add a small point, it becomes a distinction, Birinder, on the, so for example, when COC vote, there can be a distinction between a strategic voting with respect to the feasibility and a class voting. So when you talk about other jurisdictions which have their insolvency laws, especially when we see in the scheme of arrangement of the system, they used to have this concept of a class voting on a particular. So ultimately, the idea of a class voting was they have to take take their interest into account. So more and more, this number will increase. Even if there's an authorized representative, the approach will always be a class voting. The approach will not be a strategic voting, which was actually envisaged for the committee of creditors earlier.
Yeah, that's right. I agree with you.
And do you, maybe the question is for Birinder or Akash, do you, as once the resolution plan is sort of approved by the NCLT and it, goes in for implementation, are there any sort of suggestions that you would have that any changes that should be made to the regulatory framework on making that implementation process easier, less cumbersome from a bidder's perspective? Any thoughts around that would be useful.
So some of the challenges which we generally face in going into an implementation process is all the stakeholders, especially from someone who, say, a property tax recovery agency, a regulator in the form of a building plan approver, some of the banks. So they are not very akin to the entire IBC process, and hence, the, the process of actually educating them, bringing them on board, explaining to them how the IBC process actually works in, how the resolution plan actually needs to be implemented. So this is, I think, a learning curve which all of us will actually need to go through. We've seen, of course, some of the more advanced banks, or they're more akin to what a resolution plan and how it works, but a lot of the authorities are not quite aware of this.
Right. Yeah, right.
More
I think that
local authorities.
there needs to be better, I think, coordination on that front, not just maybe in real estate, but in some other sort of sectors, regulated sectors as well. I think one question, Akash, for you is, given we've spoken so much about insolvency, the insolvency code and the real estate sector and how it's working out, do you think that there is a need for, maybe a different mechanism to resolve this? I know there was the Amitabh Kant report, which suggested certain sort of solutions. What are your thoughts around that?
Yeah, thank you, Asit. So as I was saying, like going forward, because right now we are at the mix of two very big policies getting implemented together. One is the RERA Act, one is IPC. Going forward, if RERA is able to achieve its own purpose to actually standardize the process a little bit, then intervention will become very much necessary. So I'll try to explain it in this way, that as Amitabh Kant report also rightly said, that IBC should be a measure of last resort. But the problem happens with respect to default as a triggering factor, because there are 2-3 stakeholders in play. There is a lender who is focusing more on the returns on his investments. Then there are home buyers. So robustness on the side of the RERA Act will become very much necessary, because right now the regulatory structure of RERA Act is divided state-wise. We don't have a central regulator who can actually robustly get into this picture. So one of possibly an approaches can be that right now under Section 7 in 2020, they created a bar of home buyers approaching and filing an application under Section 7, for example, 100 home buyer, a 10% requirement. If at all RERA is able to align itself in a way where it can catch, if suppose there are default with respect to 90 flats or 9% of the total flat, they are able to take an action at that level, then these issues can be solved at the RERA, under the RERA regime, because RERA also under Section 8 has all the powers to take over a project, to convert the project, and they should ideally come up with more standardized policy, so that from a developer and from also a home buyer perspective, they are aware of their rights over there, because they might be more aligning and more focused on redeveloping a project rather than focusing on the insolvency. And if at all the bar reaches to a level wherein there has been 100 home buyer or 10% or whatever criteria policy call decides, then it should be invoked. Then IBC should be invoked for a more of a unified concern with respect to the corporate debtor as a whole. So there have to be some staggered approach, but with respect to this approach, the initiation points should be very clear, so that there should not be an overlap forward.
Right. Thanks. I think that's very useful input, Akash. And I think with this, it's been a very interesting session, and I'm sure we agree that we can discuss and deliberate these issues for several hours, but we have a finite time, and we have a few minutes left. So if there are any questions from anybody, would be great if you could please type them up in the chat box, and I'll request the panelists to answer the questions. There is one question which is there right now from Sumit Arora, and he says that, is it right to say that after IBC 2016, recovery time has reduced? If it is so, then how will we justify loss of intrinsic and book value of the target company? where are the buyers and investors to invest in default cases? Is there a private retail market in the domain? And do you see a need for a retail investors like REITs in bad debt cases under IBC? Anuj, do you want to, maybe take a crack at answering some of these questions?
Time, see, the first part is easy to answer. Time has definitely reduced. Earlier, there was a World Bank study we quoted everywhere that it used to take about average 4.5 years for insolvencies in India to resolve before the IBC regime. I think now that time has come to 1.2 or nearly 2 years, 1.8 or something. But the fact is, what we need to appreciate is in the first few years of IBC, there was the flow effect and the stock effect. A lot of the cases that went into liquidations and insolvencies were cases which anyway had no trading, which anyway had no assets, which were hanging around either in BIFR or any other regime or for last many years, and their natural outcome was a write-off or a liquidation. Once those resolve, I think what will be a good measure to see that when a default happens, how soon the case gets admitted to IBC and how soon the resolution happens. I think that should be the real test, and things have definitely improved. So for companies which have gone into stress fairly recently, the outcome, intuitively, I can tell you the outcomes are much faster and much better. So time is definitely improved. It's a more structured regime. And in terms of the market, I think that is still evolving. The buyers are still coming around. The moment you have certainty of outcome, certainty of time, there will be investors. Institutional investors today are more or less absent as resolution applicants. It's only strategic players. Very few private equity or funds actually come in as resolution applicants because they have committed capital. They don't know when this case will get resolved and when the transfer handover will happen. So certainty of time and certainty of outcome. Once you resolve this, you'll have institutional money coming in. And lastly, I think one area which is quite less focused and ignored is the absence of independent, credible management teams. You can put in money to buy an asset, but where will you find credible and independent management teams who can actually help you run the business, turn it around, and then make money out of it? So I think I'll leave it at that because there are many other questions.
Sure. Thanks, Anuj. There is one question which is saying, can a RERA court override the rights of the secured lenders and hand over unsold inventory to the home buyers? Akash, do you want to, give a stab at this?
Yeah. See, I think to my understanding, they can't, of course, affect the rights of the secured lender because their focus is more from the home buyer perspective. But if they're able to resolve this project specific issue at a much more starting stage, then at least the investments of the secured lenders will be secured. Like if they're able to ensure that how the projects are managed, there is no misutilization of funds that is happening. So if that policy is there, then they'll be able to secure the interest of the secured lender. But to my understanding, I don't think they can go forward and decade their rights as a secured creditor.
Yeah, I think you're right. The RERA court can't basically ask the secured creditors to relinquish their rights because that right is there. They could, obviously ask the developer to get the project completed within a faster time frame, etc. Award penalties if there are any delays. But the rights of the secured creditors can't be taken away by any order of under RERA. There is a question.
I'll tell you, the devil lies in the detail. Normally, what I've seen, creditors, lenders have rights over the surplus cash flows from the project. How do you define surplus? Because if the RERA court orders compensation payable to home buyers for delays or stuff like that, or cost increase happens, that eats away into the surplus of the creditor, and eventually he will only end up with what's left after paying all the obligations, even the RERA orders that have been passed. So
You're right. Yes.
Very often you don't have specific units being mortgaged to the lender. It's always a project surpluses.
That could be the case as well. Yeah, right.
Yeah.
The next question is around project-wise insolvency. And the question is, do you think allowing such a mechanism will undermine the value and intent of the IBC? At the end of the day, it is the same management which is taking care of all real estate projects in a company. And from a resolution perspective as well, market will react positively if it is a mix of good projects and stressed projects compared to only stressed projects. I think Akash, you did allude to some of the stuff around this, but maybe some further thoughts on this.
Yeah, of course, the concern is quite valid because even with the project-wise and reverse CIRP, the interplay with respect to policy around Section 29A becomes very crucial, whether the company has to go back to a promoter and all. But that becomes a crucial point because when you talk about, so there has been a lot of discussion with respect to project insolvency and reverse CIRP and how to standardize this thing. But the interesting fact is that because of the subjectivity that the courts are actually offering, because if you see the structure of IBC, that subjectivity with respect to involvement of courts in actually resolving and participating and taking actions with respect to how the creditors and the lenders actually has to respond was not there. The entire idea of IBC was that it has to be a process wherein courts involvement is minimized because of the experience that we faced in BIFER and other regimes, wherein we let an institution decide the viability of a company rather than the creditors themselves. So that was a shift, but this subjectivity becomes very much important because the reason, as like Anush can of course explain in more detail, the reason there might be a case like each in real estate project insolvency, whenever it comes before the court and the kind of orders that are coming up, they always involve a specific type of subjectivity to it, which can actually be addressed by the court. So in certain cases, the promoter might appear to be like a legit promoter who might be willing to give funds to complete the project. On the other hand, in other cases, the promoter might not be interested in the project and to revive the project and provide any fund for that matter. So this subjectivity is something like, and I'm also saying because for the project-wise insolvency and other stuff, this subjectivity becomes very much relevant because we can't standardize a case format that this is the way every project which comes into the IBC is structured. And that's why the role of courts will become too much important. If at all, the project-wise insolvency and reverse CIRP has to be a success in the present IBC regime.
But you know, it's just that if you are sitting as a lender in some other project and you know your project is going well, and it's happened to us. You know, we've actually revived a project. That project's going well. We thought life is good and happy, and suddenly from somewhere, uh, your company gets admitted into IBC, and it has nothing to do with your project. And then you know you spend the next 6 months trying to figure it out, saying, "Oh my God, I can't even run." You know, life was easy going for us, and suddenly, you know, we are running around IBC trying to protect our project. So yeah, just depending on which situation and which leg of the transaction you're in.
And I guess in these kind of situations, it's important that if you're lending for a particular project, then you also have exclusive security on the assets of that particular project, because then you can ensure that even in an insolvency situation, if you have to dissent from a resolution plan, you would at least be able to get that value which your project has, which will be paid to you before the other creditors. And the recent judgment of the Supreme Court in the Ruchi Soya case has in fact endorsed the right of dissenting creditors to get the liquidation value of their security in advance to the assenting guy. So that's maybe one of the issues that lenders can consider when they are dealing with a situation where there are multiple projects in a company and you are lending only to one project.
So look, I think from the perspective of like, project-wise resolution plans, I think that's honestly that makes a lot of sense because the economic unit really is the project, right? And a project goes insolvent. It rarely very happens that the entire company has gone into, like, a real estate developer has gone into insolvency at once and all of the projects are insolvent. So from that perspective, I think it makes sense. I think the issue that regulators are grappling with is obviously like that they shouldn't go completely counter to the 29 in thought process. And I think there may be a mid path to be kind of had here, where there is a resolution professional for the entire company, but there are various resolution plans, like kind of proceeding in parallel, and there might be viable projects which don't really need any extra financing to come in, and that those can kind of keep proceeding on their own path, where somewhere if there is some surplus which comes out from those projects, then that can go towards the resolution of the insolvent project. And this also kind of recognizes the reality that this is how developers function, right? It doesn't happen that developers effectively ring fence their equity in a project. They obviously cross utilize equity across projects, and hence you can't really just say that all separate. I mean, projects are all separate, and that there is really no cross linkages. It goes to the earlier point I was making. So I think what has been mooted right now, that the company needs to go into a CIRP, but yet resolution plans can be like project wise. I think that makes imminent sense in my view. Like, and I do agree with that statement that if that package is effectively offered as a financing or a collateral package, I think that would bring down the risk premiums on some of these financings quite meaningfully.
Oh, thanks, Vikas, for those thoughts. There is one last question, which is on the IBC framework has challenges when the land and development rights are in different entities. Is there a legal modification required to handle such situations? Any of the panelists have any sort of thoughts around this?
Ashit, my limited view on this is that, as long as contracts are honored, it is not required. Because at the end of the day, even if you have development rights, there is a process to the madness. You have contractual obligations. If those contractual obligations are honored, then we really don't need a separate law. We really don't need to bring land in. Problem becomes there are these contracts, but these contracts are not recognized. They're not honored. The promoter or the owner of the land tries to make dual interests or interests of different parties on the same piece of land. Those are the challenging aspects. But if a third party obligation has been created, even if to a related party through proper contractual arrangement, and those contracts are honored, then I don't think we need this, because then where will you distinguish? If you are doing a EPC business, it's all around contracts. There also rights are created, assets are given, taken, money is lent, given, basically on contracts.
That's right. I agree with that, Anuj. And I think in a JDA situation, a lot of times the JDAs are also registered, or they ought to be registered. So you have a additional right because there is a registration of that contract with the authorities, and you really can't just terminate the contract. So it's important also when JDAs are being drafted to make sure that there are no termination rights available if any of the parties goes into insolvency. And to also make sure that those JDAs are registered with the authorities so that the right is more robust if at all any of the entities goes into an insolvency situation. I think there are no more questions. So I think we can end this panel discussion. I would just say thank you to the panelists for your time and for this very interactive discussion. Ashwin, over to you. Thank you.
Thank you, Ashit. I'd like to thank our members for such a robust response. Some pretty challenging questions. It was really interesting to hear the response of the panel. Our panel is no less than celebrities, so folks do watch out for our LinkedIn and YouTube channel. The video of this session will be available, so I think the link will be available. Feel free to spread the word, come back and have a re-listen to what this panel of celebrities had to say. To our members and to anybody out there, we welcome feedback, we welcome questions. If there are any other events that you'd like us to cover, please do let us know. Last but certainly not the least, thank you to our panel. Really, on behalf of INSOL India and the events committee, for your valuable insight and perhaps more so your time, particularly in the month of March. So I appreciate what that means. So thank you so much for that. This is just the beginning. We hope to roll out many more such webinars and events on a periodic basis. So please do watch out for this space. We promise to try and keep the bar as high as what this panel has delivered. So with that, thank you very much. And we can close this webinar. Thanks, everybody.